Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, joined by my co-host, Brian London. If you have not already, be sure to subscribe. Hit that button on YouTube, BitChute, SoundCloud. We have an old friend of both the show and of the New Orleans Investment Conference, Albert Liu, on. He is the founder and CEO of Luma Financial and the producer of the Rule Symposium, which has been virtual for the past couple of years, but is an event up in Vancouver. And there's a lot going on. As always, Albert, welcome to the show.
Thank you, Fergus. It's great to be here. I'd start maybe by congratulating you on episode 1000. I assume it must be at least that high if you've gotten through the Rick Rules and the Doug Casey's and you're down to me. But no, congratulations on a great show.
We actually just hit 500. So no, wait a second.
All right.
5 years. So about 250 episodes.
Nice work.
But no, so the big topic in the gold bug world has been the elevated inflation in the United States over the last few months. And you have such communications experience. You mentioned earlier that you just find fascinating the way that inflation over 5% is not ringing major alarm bells. It's not sending gold through the roof. Why is that?
That's correct. I mean, inflation at 5%, and this, is by the government's measurement. So we have to keep that in mind as well. Real inflation is going to be much higher than that. But there was a time where, 5% inflation, would be quite alarming, to people. And the Fed's own target is around 2. And so we're at 5, yet, today we have, Jerome Powell talking virtually at Jackson Hole. And, he shows no really real concern about inflation. And instead, the conversation is, tightening too soon, tapering too soon. That's probably not a wise thing to do. That could cause problems. And I think that maybe they've taken some lessons from my wife in forward guidance. My wife, she's a pro at this. She'll start very early and she'll say, oh, this coat, this is like, 2 seasons before the actual event. This coat is kind of old. It's like, and it's not very warm. And I might have to get a new coat sooner or later. And she keeps talking like that. And then one day out of nowhere, there's a brand new coat. And I'm like, huh. But then thinking, well, yeah, she's been talking about it for a long time. And so I've been kind of prepped for that. And I think they've been doing that with sort of interest rate policy and QE and all their other measures, even with the reverse repos. This we may need more of this. We may have to expand the level of it. They're very good at preparing us. So when it actually comes, the market is fine with it. So you see, like I said, gold is not responding the way it would have. The market is not responding. Interest rates are not responding the way they would have before if inflation was at 5%, and looks like it's going to go higher. If you look at, for example, real estate prices are up, I think it's 15% year on year, probably more in certain places. Where I am in Southern California, you can definitely see it. People are, they're putting 40 billion a month in MBS, which has got to help. But then you also have COVID, the remote workplace and whatnot. People are able to move, and why not move to the place you always wanted to live if you don't have to live where you are? So all of that has resulted in a booming real estate market. You don't see that right away. It takes a while for that to work itself into the rent, which is what shows up in the inflation figures. So it's about 2 years if you believe the Dallas Fed. It's about 2 years it takes for those to work their way in. And even once they do, you're not going to see it in the PCE because it's a pretty low component of the PCE. But if you look at core CPI, I think in 1 or 2 years, you are going to see it. So, we're expecting higher inflation, I think, or we should expect higher inflation. And the world is just not reacting to it yet. And, before we started, Brian, you kind of alluded to the difference in delivery between the Greenspans and Bernankes and Yellens. And yeah, I think the strategy now is almost like a gaslighting strategy, or they just talk out of both sides of their mouth. They say, oh, I didn't say that, or I said that, but this is what I meant. Greenspan was very different, but he accomplished the same task by confusing everyone. So you really would walk away not knowing what he said. And someone, I think, quoted him once as saying to a journalist that I can tell by the way that you sort of recited my remarks, that with the clarity you did, that you didn't really understand what I was trying to say.
And he said, and if you did understand what I was trying to say, then I was mistaken, or I messed up. That wasn't the intent.
Yeah, but how much can the communications of the Federal Reserve actually impact fundamentals? That's the bizarre thing to me. A bunch of guys talking about issues. How much can they change the fact of supply and demand? The facts of supply and demand.
Well, they can't obviously change the laws of supply and demand, but I think they've found that talking is far more useful than the sort of conventional actual policy tools, because look at the balance sheet now. So the balance sheet is somewhere around 8 trillion, I think. And so that's a lot of weight, obviously, that you can throw around in the markets. But if you can just talk, and you can affect the broader markets, or if you can affect foreign central bank policy, I mean, that is a much more powerful tool than just wiggling around interest rates on reserve balances. So I think that they've discovered essentially that guidance is the main policy tool. Their actual tools like QE and interest on reserves and whatnot, that's sort of the threat behind the policy tool that sort of makes it work. But oftentimes they don't even need to resort to that.
Yeah, Albert, I think that's a great point. Their tools, I think, are ineffective. I don't think their tools will work. They can't raise interest rates like they would have in the past to combat inflation. And anybody with any sense sees that. But right now, you're right. They're gaslighting the markets into believing that they could do something when they really can't. One of the things that strikes me is that Wall Street is believing them. All common sense, the emperor has no clothes. All common sense has left the markets. And they're actually forecasting much lower inflation. Right now, real interest rates, 10-year interest rates, if you deflate them by the inflation break-evens in the TIPS market, it shows that real interest rates are around negative 0.9% or something right now. If you deflate the 10-year yield by the CPI, then real interest rates are between negative 4% and negative 5%. And that runs parallel to the worst levels we saw during the 1970s when people were panic buying gold and silver and everything else. But prices are set on Wall Street right now. Prices of gold and silver are set on the COMEX. And those people believe what the Fed is saying. They're buying a hook, line, and sinker.
Yeah, and I don't think it's necessarily that they don't see what we see. I think what is often going on is that either their metrics are relative, so they're just looking at the next guy and they got to beat that guy. So, right. If you're running a bond fund, you're just in that world looking at the guy next to you, and you gotta to keep your job, you just have to be competitive. And the other thing is time horizons. So, I look at 5 to 10 years and beyond. A lot of this discussion we're talking about, this is happening in the overnight market. Right. So this is very short-term thinking. What does Rick say? He says, a lot of people, they don't want to hold a stock over a long weekend. It's even worse than that, I think. I think people are just looking day to day. And so if you look short term like that, I think you're going to arrive at some very different conclusions than if you're like us and you're looking sort of backward through history and then forward 5 or 10 years. I think you're just going to arrive at very different conclusions and very different strategies for investing.
Is this going to change, Albert? Is there going to be a break or a threshold point where suddenly people start to panic if we go, let's say, another 2 months or even crack 6 or 7%?
Well, when the short term reflects the long term reality, which it does, periodically throughout time. Like, for example, when we hit a debt ceiling, something like that happens where the short term reality reflects the long term problem, then everyone wakes up. But as soon as the thing's resolved, even if it's a short term band-aid, they go on back to what they were doing before. So markets get roiled up for certain reasons, and then they go back, and that can happen for a while, as we've seen. It can't happen forever, but how long can it keep going for? I have no idea.
Well, given the Fed's recent history of putting out trial balloons and hints there and a few comments there about tapering, do you think the markets have at this point discounted the tapering plan that's probably going to come up with some kind of specificity in the Fed's next meeting in September?
Yeah, I think the market is getting clarity. So once in a while, someone will say something. So earlier this week, we had, I think, the gentleman from St. Louis or the gentleman from Massachusetts speak, and people got a little bit concerned. Okay, that, we're going to start tapering in the fall. But this is sort of their like 1-2 punch strategy, where they do that, and then Powell comes back in and says something else and sort of puts us all at ease. So I think that, if I had to guess, I would say, yeah, even when tapering does begin, it's going to be minuscule. It's going to have a very long tail. It's going to take a long time to play out. And then by then, who knows what will happen, right? Maybe there'll be another variant. There'll be some other reason why they can't see it through. And so I don't expect them to see it through. And, I suspect they'll have a pretty good reason to not see it through, at least according to the markets. The markets will be willing to buy it.
If we look at post-2008, we can see the course that the Fed is likely to take ahead as they try to normalize and then, of course, to cut back at some point. But things are moving so much more quickly this time around, as we've seen also in the post-pandemic experience. So do you think that, let's say, looking at precious metals, looking at gold in particular, the first Fed rate hikes in December 2015 marked the bottom of that gold bear market, and then gold took off from there, or at least started rising here and there, and that was definitely the bottom of that market as the paper speculators let off of their shorts, as the Fed actually began to hike rates. Do you think we need something that definitive this time, the Fed actually beginning to hike rates before we see a turn in the markets, maybe gold in particular? Or will tapering and their kind of hesitancy to taper allow the markets this time to kind of rhyme with the past, and maybe that marks a bottom or marks enough clarity that gold and precious metals and other inflation hedges can actually start to really react to the signals we're getting?
Yeah, that's a really tough question that I can't claim I have the answer to. But if I had to guess, I think where we are now, we could possibly see some sign of real inflation. So sort of like a first order trigger rather than, shorts or something else triggering it. We could get some real scary news if you see. So I was at a McDonald's the other day at a drive-through, and they had this big sign, hiring $15 an hour starting, okay, right out front. Mm-hmm. And the line to get your order is just incredibly long, and it's moving so slow. They have like second window, third window, fourth window, fifth window, like you just have to wait. And so I'm waiting there, and I'm eventually waiting so long that I just get out of my car and go in. And the manager says, "Oh, I just brought your food out. Here you go." And so I asked him, like, what the hell's going on here? And he said, we're trying to run a 15-person shift with 4 people. And wow. I think this is happening in the food industry all over the place. So obviously part of this, or a big part of this, is the wrong incentives, right? People getting paid to stay at home. That's what he blamed it on. And sure, that's obviously a big part of it, and that's a big problem. Obviously, if you have people being paid, so sort of the economic incentives have been turned on their head. So, people don't have to pay their rents. People can stay at home and not work. All that stuff is obviously not good for the economy. It's just not a very good, it doesn't set up a very good evolutionary pattern for the economy, right? Imagine if having sex felt like reading a Paul Krugman article or, attending a Fed meeting. It just, the species would die out. And so here we have like sort of our economic engine. We've got all the wrong incentives. And so the economic engine is dying. And so I guess what I'm getting to is even if we get past this point of sort of the government paying people to stay at home. And by the way, actually, I just saw a story on Bloomberg recently that was speculating that, some of these states that have terminated those enhanced benefits early are thinking about putting them back on, which would be like putting the knife back into the patient, like you stab the patient with the lockdown and all these subsidies and stuff, and you're finally, removing this thing, and the first sign of blood, you want to just jam that knife back into the patient to stop the bleeding. But to get back on track, even if we get through this, I mean, the economy has suffered severe damage, and I think that now is the time where all this inflation that we've only seen really in asset prices, now is the time where that's going to start flowing into wages and show up in consumer goods and commodities and services for the masses. And that kind of a signal, I think, is something that could really set off the inflation hedges that you're talking about. Once we start seeing like wages, they call it the wage price spiral. I don't really follow that, but there is something to it. Like it hurts more. It really hurts once it gets into wages and prices of the things that everyone uses. And I think that we're a lot closer to that than we were before. And if that happened, we would definitely see these inflation hedges really boom for the right reason. It wouldn't be just a technical reason, shorts coming off or something like that. This would be the real thing. It wouldn't be a drill.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, I'm Brian London, and I am here this week with our CEO interview. We have the great pleasure to welcome back Cameron Timstra, the CEO of Tarachi Gold, symbol TRG, on the Canadian Stock Exchange. And Tarachi Gold is part of the Inventa Capital Group, of course, which is the sponsor of our Gold Newsletter podcast. Cameron, big news out. We finally got the resource or the grade of your tailings resource. One of the key, if not obviously the key aspect of Tarachi Gold is the fact that you have the Magistral project in Mexico, which includes a mill and an historic tailings resource. Now, you've just gone through and drilled that resource and gotten the results back, and the average grade has come in at over 2 grams per ton. Now, Cameron, that's a great grade for an open pit project. Typically, open pit project is 1 gram per ton or lower. So you've got twice the grade. You don't have to mine the rock. You don't have to crush it. You don't have to do any of this stuff. That's basically scoop it up and run it through the mill. So you save tremendously in operating costs, and you've got a grade that's about double the typical open pit project. I mean, you have to be satisfied with those results, huh?
Satisfied with the results. I mean, it was sort of a long time coming. We had quite a few delays that we experienced at the lab up in Canada. So, we've been patiently waiting for the results of this drill program. And now that they're finally here, they certainly didn't disappoint and certainly met and exceeded our expectations. Like you said, you hit the nail right on the head there. 2 grams per ton is excellent for any open pit scenario. But the fact that our material has been mined, crushed, and ground and is adjacent to the mill We expect the actual mining costs to be pretty insignificant compared to most open pit operations. And even our metallurgy results, we're just starting to see those come back now in terms of the leachability of that material. So not only is 2 grams per ton a great grade for the material itself, but we do expect to see pretty significant gold recoveries with that material in the mill.
And now things are starting to move very quickly. And I look at it that you've just rounded the final turn and you're going into the home stretch toward actual production, because again, you have the mill sitting there, you have the resource sitting there very easily mined at a very high grade for that kind of an operation. So what's left? You've got, I guess, a resource estimate and some metallurgy and a PEA, but those are coming right up, aren't they?
Yeah, now that we finally have the assays in hand from the drill program, Ausenco can go to work compiling those into our expected 43-101 compliant resource estimate. That resource estimate is going to come out in the same report with the PEA, and both of those right now are scheduled to come out sometime around the 3rd week of November. We should hopefully have some of the results from that even before then, that we could perhaps release to the market a couple weeks earlier. But yeah, that's really been the final key piece that we've been waiting on, are those assays. Now also, like I mentioned, the metallurgy results, and that's the only thing that's really been holding up Ausenco from being able to complete that PEA. And once we have that information in hand, we'll be able to make our final decisions on what the flow sheet's going to look like, and what sort of upgrades we want to make into the mill before commissioning that facility a little later next year.
You look at junior mining companies, and an experienced investor in the sector looks for catalysts and upcoming catalysts. I think that PEA is going to be a huge catalyst for you, because the reason why I originally recommended Karachi Gold in Gold Newsletter was because of the kinds of cash flow you're going to get from this project. Very little capex to get in production, relatively high grade, very low mining costs. You should have a very robust margin on the production. And at the rates that you're going to produce, I've looked at it and just roughly figured that you're probably going to have free cash flow, a run rate of free cash flow annually that's in excess of what your current market cap is, considerably in excess, actually. And that fact, or those numbers, are going to be revealed very shortly to the investors at large. So I think that could be a huge catalyst and a reason to re-rate the stock, coming right up again.
Yeah, we're hoping the market is going to think along the same lines as you do, Brian, and you're absolutely right. I mean, at a plant capacity of 1,000 tons per day, and the sort of gold grades we're seeing and the recoveries that we expect, we do anticipate to produce a minimum of 15,000 ounces a year with this project, and at an all-in cost of probably about $1,000 an ounce or less. So at these current gold prices, we are expecting to be producing roughly the equivalent to our today's market cap on an annual basis from cash flow.
Yeah, that's very powerful, and pretty quickly too. You're talking about going into production next year, right? Second half of next year, or first half of next year, mid-year?
Yeah, with the PEA expected soon, we plan to spend most of the first half of next year getting the facility up and ready. We've got to do a little bit of work at our tailings storage facility to make sure that's ready to start receiving tailings again, and sort of make some upgrades within the mill itself over the first couple months of next year. But we do plan on starting to commission that facility by the end of the first half next year, and then reach commercial production in the second half.
So it's also a bit of a double-barreled opportunity here, because you've got the production coming up. You're going to have cash flow, and very significant cash flow relative to where your current market cap is. But you're also going to use this cash flow and the mill as kind of a base for expanding in other projects. You already have a couple of other very significant projects in the region, and there's a lot of production, small scale production in the area, and you're kind of sitting in the catbird seat, aren't you, from either consolidating the area or exploration?
Yeah, there's certainly some potential around Magistral to look for sort of in-ground resources again. I mean, where the ore came from that produced these tailings historically, all those old mines haven't really seen any sort of operation or modern exploration since sort of at least the 1960s. So there's certainly some potential in the region to consolidate the old concessions covering these old mining operations to search for more ounces at depth or along strike. And also on our own concessions up in Sonora, We sort of put the drill down just for now while we focus on Magistral, but there's certainly a lot of potential for us to get back up there, particularly around our Habali concession, where we had some really exciting results earlier this year.
Yeah, you had some great gold grades from that drilling earlier this year, and I know you're eager to follow that up. But first things first, get those millions upon millions of dollars in cash flow coming out of that tailing facility. And again, the catalyst right now that we've all been waiting for is that PEA, where you're actually going to show the market the kinds of numbers that the company will be generating next year. And the comparison, again, to your current market cap creates one of the more exceptional opportunities that I've seen in the market, and why we've recommended Trachy Gold in Gold Newsletter. So looking forward to that, Cameron. Great news here, and the window of opportunity, as it were, for those numbers come out is only a few short weeks at this point. So looking forward to that news coming out, and thank you again for joining us today.
Thanks, Brian. Always happy to be here.
Yeah, post 2008, that tremendous liquidity injection was kept within the bounds of Wall Street. It was just recirculating within the financial markets largely. But this time around, because it's been funneled into a lot of fiscal spending, and more to come, by the way. We've got about $4.5 trillion more of fiscal spending on the way. It's a different story. And that's real money. We have the $3.5 trillion soft infrastructure, the $1 trillion hard infrastructure, ladled on top of a $6.5 trillion budget that they already had, Biden had already proposed. It really seems like we said before, the Fed is pretending that this doesn't exist, and the markets are choosing to pretend that it doesn't exist, because the repercussions are always further down the road and non-immediate, not next week, which is the extent of their time frame.
Right. And you can see how they're getting in deeper and deeper too. I mean, they've been talking about normalizing interest rates for as long as I've been doing this. QE was supposed to be temporary. The reverse repo facility was supposed to be temporary. Now they're relying on that more than they ever imagined or admitted would be the case. And they're just getting deeper and deeper into this. So, so I think, I don't know how much runway they have left. They certainly have impressed me with how long they've been able to continue. But you can see they're boxing themselves in. And don't forget, on top of the spending, Brian, we might be setting ourselves up for another war. If you heard President Biden talking about the manhunt that he wants to start in Afghanistan, who knows where that's going to go. So there's lots of spending coming. That spending is not going to come from conventional taxes. It's going to come from inflation. And that can only end in one place.
Right. Of course, inflation, Albert, does not come in a uniform fashion, right? It pops up in different areas. And maybe Brian wants to touch on this as well, the way that some inflation is more visible to different people, right? So, of course, housing prices, as you said, are visible to buyers and sellers, but they're not necessarily visible to renters until maybe a year or two later. Are there any particular forms of inflation or parts of the economy that are more, that have greater elasticity when it comes to precious metals prices? So some things that would actually really catalyze a run.
Brian,
what is the history
on
on
that, first? While I think about that, that's a good question.
Well, I think that what's going to catalyze the move in precious metals is this type of classic monetary inflation, monetary money policy driven inflation. You mentioned the war in the potential for war in Afghanistan. I don't think Biden's going to go back in there, but it does illustrate that you have this kind of safe haven demand for gold that pops up every now and then from geopolitical crises, which is really ill-founded and doesn't last, and is no reason to buy or sell gold either way. But it's this monetary issue. The monetary bull market that we're in right now is the kind of thing that can take gold to much higher prices. I think it's broad-based inflation that drives that. Yeah, we're going to see it in different areas, but the key things about inflation this time around, to me, is that it is erupting in areas that are more persistent and stickier, like wages. It will be. That's what's coming up. The people today people are active in the markets. Traders that are moving the markets have no experience with inflation. It was, 40 years ago or 50 years ago, since they actually started the inflationary spiral that led to the great bull market of the 1970s. So people today have very little, no experience with that. And the upshot of it all, and the truly sad part of it all, is that the rich can escape the effects, the repercussions of inflation. They can even profit from it. But it's a tax on the poor and the middle class that they cannot escape. And then it becomes a spiral. And it's really ravaging. And it's hard to believe that 50 years ago, Gold Newsletter was created because, Jim Blanchard saw this coming because of the dollar severing its ties with gold. Now we're revisiting that, and people are going to get a dose of what that means. And the great fear of inflation that's been proven throughout human history is that it robs people of not only everything they worked for. It's not only a tax on everything they work for and are working for, but it robs them of the incentive to really work harder because they're not getting as much from it. And it mutes that dynamism, like Albert was saying. Once you start paying people for staying at home, then you start to throw cold water on that dynamism that is the U.S. economy. And frankly, that's the one thing that's the hope of the world right now, is that kind of innate dynamism of the U.S. economy.
Yeah, I tend to agree, Brian, that you have to create a heck of a lot of money to dilute it over a growing U.S. economy. So long as there's a great productive U.S. economy, hyperinflation is basically out of the question. But we still, so that's the offshoot. That's why Keith Weiner actually has been debating a few people on Twitter. He's one of these inflation gurus, who's saying that it's really a problem of this constrained supply that is making inflation higher than it would be otherwise. So are you concerned with that too, Albert? The way that obviously we've got the supply and demand side, that the supply in the US is just still constrained. I mean, we've been talking about the New Orleans conference about all these scares of vaccine mandates or whatever, which doesn't apply to the conference, but in general, people may be more restrained at this time.
Fergus, I'm just processing your question. I think it's a brilliant question, the original question, because it gets to the heart of the brilliance of the Fed. So if you think about, what would we look at to know that inflation is out of control? Well, that's precisely what they've been able to control so well. So, for instance, maybe at one point we used to look at M3. Well, that's gone. People looked at M2 for a while, but that didn't seem to work very well. So we lost interest in that. The 10-year Treasury is another place you would look, like interest rates in general. You would look to reflect inflation expectations. But they've been able to control that very well by controlling, the low end of the curve and having that ripple through. And when that didn't work, they brought on QE. So you're looking at low interest rates, which on the face would tell you that inflation is not a problem, even if the Fed is basically swallowing all of the Treasury issuance. So that's misleading. The other thing you would look at is perhaps your standard of living. So like, what am I able to afford? But through sort of the whole, the move towards outsourcing and globalization, bringing on like the coincidence of China industrializing at a time when, production here was getting very expensive, helped a lot. So we're still able to go to Walmart or Target or whatever and load up the groceries and come back, Christmas presents or whatever, still live a good life. Expanding credit has helped with that as well. So, everyone has all these revolving credit lines, right? Guaranteeing student debt. Like they've done a lot of things that have sort of concealed,
camouflaged
the normal effects of inflation. Absolutely. Everywhere you look to see inflation, they have a way of sort of covering it up. Even the price of gold itself. So gold is something that would respond to inflation, but even the price of gold itself could be manipulated to make it look like there is no inflation. So I think they've just done a great job of hiding what they're doing. Really the Fed balance sheet is still a good indicator. But when that doesn't translate to these other things, people can look at you and say, well, no, you've been wrong. You guys who are worried about inflation and hard money and all that, look, you've been wrong all along, because we have 8 trillion here, yet, prices have been relatively stable, which is hard to argue. Relatively. I mean, I don't like 2, 3, 4, 5% inflation, because over a long haul, it does add up. But it doesn't match what we've been seeing in the expansion of the money supply. And I think they've been really good at that. They've just been really good at cutting us off everywhere you would look to say, aha, there it is. They've been right there with some answer or some diversion or some way of covering it up.
Yeah, it really is an interesting point, because if you look at it, M3 started to rise, and the Fed cut out reporting of M3 as a cost saving measure. And this is an organization that has like 500 economists making over $200,000 a year, and it would take one economist about 2 hours, 1 day a week to calculate M3, if that. And they cut out M3, and nobody raised a squawk about it. Nobody said, well, no, obviously you're trying to hide something here. Then M2, conveniently or coincidentally, right after it spiked parabolically, they decide to report it only once a month. And, no coincidence there. And again, cost saving measure, but they report all this other stuff that nobody looks at. So it really is active manipulation and messaging at this point. There was a great piece came out a week or two ago by Stephen Roach, reflecting on when it was called, I think, The Ghost of Arthur Burns, when he was a young economist working under Arthur Burns at the Fed. And Burns really did the same thing, but it was in that case a matter of self-delusion rather than active messaging or propagandizing. He was convinced that all of these different measures shouldn't be included. He was the one who actually invented the core CPI measure and got there by kind of a circuitous route. But he convinced all of his staff economists that oil prices, well, we had the oil embargo, so that was exogenous. So let's eliminate that. Then every time something would pop up, he'd find an excuse for why, some specific reason why that was all of a sudden popping out. So he would remove that from the index. At the end of it, I think there was only about 25% of the original CPI index left. And it had, at that point, started to rise at double-digit rates. And finally, he admitted that there was an inflation problem. But it was only when he had removed every problem area out, every problem sector out of the CPI, and what was left was still rising. So all of those other areas contributed to everything else. In Fed, it was a feedback loop, and it created the more broad-based inflation that he didn't see, but was created really by all those supply disruptions and other exogenous events. But, at the bottom, too much money chasing too few goods. And of course, too few goods is a big part of the equation.
And that's how good they are, Fergus. I forgot to mention the CPI and tips, which is the number one way that they do it. And I just took that for granted. But obviously, tinkering around with that is as they've got huge mileage out of that.
Yeah. Right. And there are private measures, the Chapwood Index we've discussed before. And then there's also an MIT sophisticated online tool, which basically tracks, I think, even hundreds of thousands of prices automatically. So much more elaborate, but they put that behind a paywall, so you can no longer see that one. It's for private eyes only. So, Albert Liu, I hope you'll be in New Orleans coming up in October.
Yeah,
I've seen you there before. You're always a prominent man there. So the website, neworleansconference.com. Where should we send you? Go to, is it Albert K. Liu on Twitter?
Mm-hmm.
Yes.
Albert K. Liu on Twitter, yeah.
Okay, that's the best place. And of course, LinkedIn. Brian, any final thoughts before we let our man go?
No, I would guess yes. Looking forward to seeing Albert and you and everyone in New Orleans. We have recently found out that we will almost assuredly be able to host the event in person, that the various vaccine mandates will not apply to conferences, and we are free and clear to have the event. So I encourage everyone to go register right now, because there's limited room availability, and it's going to be a kind of a blockbuster reunion of the financial and hard money community.
Actually, I'll back that too. I went to book my hotel room, and unless you're booking through the New Orleans platform, this hotel is booked out basically. So Brian is not exaggerating that one. Yeah. So Albert, all the best in your new role, and we'll see you in New Orleans.
Thanks very much, guys. It's been a pleasure.
Cheers. Thank you.